Fidelity. The entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
You said it. You finally said it.
I'm so bullish.
Andy's bullish. I'm bullish. We're bullish. We're on 4th floor today. We're going to be on floor 1, and then we're headed straight to the moon, boys.
And we're live. Guys, you may think it's a bear market, and that's because it is. No, don't get too discouraged. I think there were some people that were really, really good at sifting through the noise and understanding where the signal was coming from. And so obviously what happened last week, the new Fed chair was announced, Kevin Warsh, and you know, the stock market held up just fine because he is a big proponent of Fed independence. So we saw, you know, U.S. equities stick around that 7K mark for the S&P, but man, metals smoked, crypto smoked. Just the entire debasement trade got wiped, and now we're in a phase of kind of picking up the pieces. There was a lot of ruckus happening around 1010 as well, and so I think the market structure kind of broke on 1010, and now it's just further emphasized by a rather hawkish Fed chair pick. In my opinion, I think some of these things, the hawkishness is a bit overblown. We know that Trump is not going to pick some guy that's going to be super tough on inflation and raise rates because inflation's at 2.9%. No, Warsh is a guy that has said he has said that tariffs will not create persistent inflation. Maybe they create a one-time price increase, but that is transitory. And so he believes, and I think we all believe, that, you know, we're past that mostly inflationary pressure from tariffs. Secondary, we know that Trump is going to pick someone who's willing and ready to kind of work in tandem with his mission of running the economy hot. We know he's going to run the economy hot. He wants to print GDP numbers upwards of 25%. That's absolutely ridiculous, but we've already seen prints of 5+%. So what does that mean? It means GDP up, inflation moderately up, and as long as the labor market can hold on strong, you know, everyone's not displaced by AI too soon, you know, they're going to cut rates. They're going to slam rates all the way to the floor, and that's going to cause, you know, some easing pressures on the economy. So that's what we're watching when it comes to macro and the new Fed chair, which was, you know, one of the primary triggers of what happened in the markets over the last few days. Obviously, AI Molt book took the world by storm as well. But we're going to be talking more about what is going on both in the stablecoin world, the neo-finance world, because and I think Santiago Santos put it best when he said that 2026 is going to be a year where we see tons of adoption, and particularly we anticipate adoption in some key verticals, stable coins, RWAs, lending, tokenization. But man, the prices are just not going to keep up with the fundamentals. And that may be because of this, macro fear, which should be subsided once we, get the new guy into his Fed chair. But it might just be a result of, not keeping up with the fundamentals and the new guard of crypto being these tokenization platforms, leading the way, which means that a lot of the old guard crypto infrastructure slop is going to get fallen by the wayside. So position accordingly. In the meantime, we've got some headlines to go over. And so we can go ahead and cut to our first headline, which is from our good friend, Eleanor. She has been the voice out of the White House and on Capitol Hill. She is here saying that the White House meeting with crypto and banks on stablecoin yield will start at 1 p.m. Eastern this afternoon. It is ongoing. They are going to be adding some color around Monday's White House meeting. This is intentionally not a C-suite meeting, so Coinbase chief Brian Armstrong and major bank CEOs will not attend. This is a bit more fundamental, a bit more mechanical to discuss some of the ins and outs around paying yield on stablecoins. We saw last week how Tether was kind of added into this conversation. It was almost like hearsay. Paolo ended up coming out and saying that, look, we don't have a dog in this fight. They don't currently pay out interest on stablecoin yields, and they don't need to. Look, they have essentially won the market of stablecoin issuance. They've got significant market share. They're the leader in stablecoins. Circle and Jeremy Allaire second to Tether, and so they don't need to pay out this interest to attract a lot of deposits. They're seeing significant market share already, and if they were to stand up some sort of bank, consumer bank or neobank, that could trigger some outposts from the legacy financial institutions, but they're not in a race. They're not planning on doing so anyway. And so Tether is saying, they don't really have a dog in this fight. Obviously, Brian Armstrong is saying they want to pay interest on stable coins, whether that be, Circle or Coinbase, it ultimately does pay. But lo and behold, this is a very complex issue, and the White House is getting involved in order to try to push this through. So we've got two really knowledgeable guests that are coming a little bit later. We've got Haonan from Codex, who is well positioned to speak on stablecoin yield, both at the regulatory level and get into stablecoin forex and what this means for geographical stablecoins worldwide. We'll be coming up with him in just a few minutes. Before we do, we've got a few more headlines that we're going to hit through. Why don't we get to our next one? This one is from our guy, Vitalik. And so the Ethereum Foundation is entering its austerity phase. Let's read from Vitalik what this means. In these 5 years, the Ethereum Foundation is entering a period of mild austerity in order to be able to simultaneously meet two goals. Before we read off these two goals, remember austerity is effectively cutting spending is really the essence of austerity. And so let's read on. The first goal here is to deliver on an aggressive roadmap that ensures Ethereum's status as a performant and scalable world's computer that does not compromise on robustness, sustainability, and decentralization. Now, usually growth is fueled by more CapEx. And so to enter this period of austerity, reduce spending, but try to deliver on an aggressive roadmap might seem contradictory. Let's continue reading. The second goal here is to ensure the Ethereum Foundation's own ability to sustain into the long term and protect Ethereum's core mission and goals, including both the core blockchain layer as well as users' ability to access and use the chain with self-sovereignty, security, and privacy. Okay. Doesn't seem like anything that we should scoff at. Obviously, we want the Ethereum Foundation to succeed and to sustain into the long term. This also came around at about the same time we saw rumblings of a new DAO. Obviously, the DAO was back in 2016. It was this very ambitious project that the Ethereum Foundation built out. And the goal was essentially, it was the DAO of DAOs. It was a governing organization within Ethereum to direct incentives, to participate in governance, to allocate incentives and tokens to the broader Ethereum ecosystem, almost like the protocol guild does now. But it was going to have a much stronger hand in a lot of the core protocols that Ethereum, had at its disposal. And this was in 2016, so it was before all of the DeFi craze and Aave and Compound and DeFi summer of 2020. But what happened to the DAO back in 2016 was it got exploited. So someone must have found a vulnerability before the thing went live, and it was operated and audited, and it was open sourced. Someone found a vulnerability, and it went live anyway, and it got drained. All the money into it got drained. And this was a very systemic and cataclysmic thing that happened in the early Ethereum lore, because this was what led to the creation of Ethereum Classic. And so Ethereum Classic to this day carries a valuation, I believe, in the billions. And the reason is because the Ethereum community had a vote. Anyone who ran a full node, and at the time, in order to have a wallet, you needed to run a full node, and you could signal with your node whether you were in support of blacklisting the tokens that were drained from the DAO or not. You could vote to keep Ethereum immutable and keep the coins in the Ethereum ecosystem. But obviously, this hacker was going to have a significant portion of the network value in the ETH token. And so the community voted to blacklist the tokens and have a hard fork of the chain, in which one version of the chain continued to live on, and the other version of the chain was no more. And that's the chain that we now know as Ethereum Classic, was the chain that kept the tokens in the protocol. And then the Ethereum that we know and love today, the second largest cryptocurrency in ETH, that Ethereum protocol blacklisted the tokens and continued on its path. And so the original Ethereum back in the ICO and way back in 2015 and 2016, the one that originally launched the DAO, that canonical chain is now what's known as Ethereum Classic. So it's a little bit of Ethereum lore for you. And so they're redoing the DAO. To this end, they're also doing this austerity. To this end, my own share of the austerity is that I am personally taking on responsibilities that might in other time have been special projects of the EF. And so austerity in Vitalik's sense, it sounds like he's just redirecting focus and pouring even more attention. They're not special projects anymore. They're actually key elements of the roadmap. Specifically, we are seeking the existence of an open source, secure, and verifiable full stack of software and hardware that can protect both our personal lives and our public environments. He links a Vitalik article there. This includes applications such as finance, communication, and governance, blockchains, operating systems, secure hardware, biotech, including both personal and public health, and more. If you have seen the Vensa announcement seeking to make open silicon a commercially viable reality, at least for security critical applications, the ucritter.com, including recent versions with built-in ZK, FHE, and differential privacy features, the air quality work, my donations to encrypted messaging apps, my own enthusiasm and use. Can continue scrolling here. For privacy preserving, walkaway test friendly and local first software, including operating system, then you know the general spirit of what I am planning to support. So they're actually going to be putting more funds and resources into this, into these efforts, which I think is going to be interesting, especially as we see some of these efforts progress. And so that's what's happening here. We can continue. So they've, for this reason, withdrawn 16,000 ETH, which will be deployed toward these goals over the next few years. I'm also exploring secure, decentralized staking options that will allow even more capital from staking rewards to be put towards these goals in the long term. Ethereum itself is an indispensable part of the full stack openness and verifiability vision. Okay. Well, we're going to move on here. We can go ahead and cut to our next headline. But this is essentially what's happening to Ethereum. And so we're going to see what happens, because there's quite a few special projects that are existing outside of the purview of the current infrastructure dynamic, how Ethereum is operating. But obviously these are very complementary pieces that will in turn, fuel Ethereum further. It almost reminds me of Tom Lee's moonshots. I think Vitalik is endeavoring on his own version of moonshots with some of these special projects he describes. Let's go ahead and continue. We've got an update from our friends over at Securitize. They hit $4 billion in tokenized assets. Shout out to our guys, Tom and Carlos. I think we're going to get them onto a debate here pretty soon, talking about native issuance. But here you can see that they hit $4 billion in institutional business. This came out today, and this is a case study about how Securitize scaled to $4 billion in institutional RWAs. And so, the tokenization case study here, they've spent years in a holding pattern. In 2025, everyone agreed it could change finance. Now we're finally seeing this come to fruition. Instead of asking whether tokenization is possible, the research looks at what happens when a platform actually builds reliable institutional grade infrastructure for it. The case follows Securitize and how they were able to build, through those early days, which were really, really flat. They didn't see a lot of adoption. They were just building headstrong. They knew the vision that they wanted to create, and then whoosh, hockey stick growth. Pretty incredible to see out of our friends over at Securitize. We're going to have them on the show again very, very soon. And they are preaching what we believe is the end game of tokenization in their native issuance model. Obviously, there's some more near-term, pseudo models that are very abstracted away. They don't give actual shareholder custody. We're going to be diving into more of those topics later in the show. What do we have up next from our friends over at Circle? These guys released their 2026 growth plan for USDC, which I'd imagine depends quite a bit on whether or not they're able to pay yield on stable coins. These guys are embracing the Genius Act, and we're going to see more from our friends at Circle very soon. They're also launching ARC. So let's speed run through this. Strengthening compliance and financial infrastructure is a central theme of Circle's 2026 roadmap. Aims to align USDC more closely with evolving stablecoin frameworks in new jurisdictions. Obviously, Genius, Clarity, these are the things that we're seeing. They have a priority on regulatory integration and transparency. I'd imagine as we see more tokenization efforts at the financial beings in the highest power, we have New York Stock Exchange pushing tokenization. We have 24/7 markets. We have CFTC and SEC collaborating. All of this is pushing tokenization further. We're getting more assets in both the speculative equities and securities front, also in the fixed income front. Stablecoins play a crucial role in both of these industries. And they're working on regulatory integration and transparency for each of these. They're going to reinforce reserve management and compliance to attract institutional capital. No surprise there. Obviously, if there is a run of which we've seen before, remember Silicon Valley Bank back, I think this would have been somewhere like 2023 to 2024, maybe actually even earlier. We saw Silicon Valley Bank was one of the banks where a lot of the reserves of Circle was stored in cash and treasuries. Silicon Valley Bank went under. We were thinking maybe they would get bailed out. Turns out they didn't. And so when that bank went down, there was some concern as to whether or not USDC was going to go down with it if it didn't have the proper reserves and it wasn't backed fully one-to-one. It did depeg briefly, but after some more of the information came out about Silicon Valley Bank, it turns out no, Circle's fine, USDC is fine. Returned the peg, and it was the easiest, quickest 10% gain that anyone would have gotten. They ended up going from 90 cents back to $1 within a couple of days at the latest. So USDC is going to become even more integrated into the regulatory environment. They're going to become more transparent, and reserve management and compliance will attract more institutional capital. This is something that we know is necessary in order to expand stablecoins. We'll also see cross-chain infrastructure, improve USDC's interop and settlement efficiency across networks. We believe ARC is going to be almost this like central hub of which they're going to route several variations of USD across all of the multi-chain. ARC is going to become a very important piece to this. They're going to expand bank and payment partnerships, embedding stablecoins deeper into existing financial rails. Payments only just a fraction of the payments industry has started to convert into stable coins, but MasterCard, Visa are really taking hold. And then, generally this roadmap signals USDC as positioning for a core layer in this emerging regulated on-chain payments and settlement stack. And we anticipate that will continue. So that wraps up our news portion of the show. We are going to take a very brief break, and we're going to be back with our friend Haonan from Codex on our stablecoin segment for the week, sponsored by Frax. And there's lots to talk about. Obviously, all the yield on stablecoins. We've got the regulatory environment. We've got Circle's new roadmap. There's tons to dig into. So don't go anywhere. We'll be right back after a quick break. Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on-chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its real upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more.
Kalshi is the world's largest prediction market. You can trade on anything in all 50 states. Go to Kalshi.com to trade today.
Talk to AI like your lawyer, or your doctor, or your therapist. Welcome back to another episode of Stabled Up, our premier weekly show covering the ins and outs of digital dollars, stablecoins, and the future of decentralized finance.
The show is made possible by Frax, and Frax is powering the financial engine of the internet, powering FRX USD and Genius compliant stablecoins. This is the stablecoin super cycle made possible by Frax. Now enjoy Stabled Up, our weekly stablecoin show. All right. Haonan, we are here. We've got our friend over at Codex. Haonan is here for our stablecoin segment, sponsored by Frax. Our friends over at Frax are doing great work. Genius compliant stablecoins, and recently just had another $50 million partner get announced and join FraxNet. So it is our pleasure to welcome Haonan, because we've got a lot to talk about in the stablecoin world. Obviously, the Clarity Act, is getting held up because banks and stablecoin issuers can't figure out where to put the yield. And stablecoin FX is getting a lot more traction as of late. But Haonan, man, it's a pleasure, because it's been a little while since Argentina. So I hope you're doing well.
I'm good, Robbie. I hear you're doing better though. You're down south.
Like,
I'm up north here.
I was just telling you, man, it's 25 degrees here. So I am in Florida, but I'm trying my best to stay warm. I know you are too.
Yeah. It's freezing up here.
What have you been up to since Argentina?
We've been heads down building the business. And so lots of exciting things going on at Codex. We hit $1 billion plus in run rate volumes. We're profitable on a net revenue basis. Things are looking good, and we're very happy.
I love it. And so, for anyone who is, it was a doozy down there in Argentina. It was a marathon. And so we had, several guests. For anyone who didn't get a chance to see that segment, give us a bit of an explainer on Codex. Obviously, you guys are in the world of stablecoins, particularly stablecoin Forex, which, is a very, there's a lot to unpack in that regard as well. But yeah, give us a sense of how you've been able to generate up to $1 billion of volume this far.
Yeah, so Codex is the first stablecoin FX chain, and we're built to make currency conversions to and from fiat cheap, instant, and always on. And the reason why that's so important is because despite stablecoins growing by almost 100 billion last year, most of FX today in stablecoin land is done in a traditional way. And so it's slow and expensive, and it's holding back the growth of stablecoins. And so what we want to do is we want to bring that activity on chain in a crypto native way. And we think this will unblock one of the key blockers that's holding back stablecoin growth. And so far, it seems like we're right.
Yeah, and you know, one of the examples that you had shared with us back then was, you know, take the example of third party currency to third party currency, almost like you know, right now, I believe, if I'm remembering correctly, a lot of the Forex and US, a lot of the interchange between countries' currencies abroad has to flow through the dollar. There's no liquid markets between you know, some of these third world nations and a lot of their currencies. But Forex is one of the most liquid industries out there. So could you just unpack a little bit, you know, if Forex is so liquid, why aren't we seeing more, you know, third world currency to third world currency flows?
Yeah, I think to separate out the issues here, I think first let's discuss like what traditional FX looks like.
Sure.
Traditional FX is a very hierarchical system, right? Originally, there were these problems with settlement risk, and so they came up with institutions like CLS that solved that settlement risk. And you know, CLS only wants to deal with so many people at a time, and so only that set of banks has actually direct access to that market, and then everybody else has to go through these banks. So you get these tiers of access, and each tier of access adds fees. And of course, you know, if you're a on off ramp in some country that's not very prominent, you're probably not at the very top of that hierarchy. You are suffering from sort of multiple layers of these types of fees. And so that's what's happening today when somebody is exchanging local fiat into stablecoins. And so it should be no surprise that it's expensive. That's the first aspect of it. And so now recall, like, why does this hierarchy even exist? It exists because there's this settlement risk problem. Basically, if Guy sends B money, B might not have sent A money yet. And you have no way of knowing for sure that's happened unless you have an intermediary. But remember, in crypto, we don't have that problem. And in fact, if you were to design the FX system from scratch today, you wouldn't need something like a CLS because it would be on crypto rails. Now, that is sort of the first principles advantage, right? You don't need this hierarchy. You don't need to solve the settlement risk problem. And so you can flatten it. And so this can create much better economics for everybody involved and cheaper FX for everybody. That's kind of the big picture of what's going on. Now, on the specific dollar point, it's true. Most traditional FX goes through the dollar. It could emerge to be the similar case in stablecoins as well, but that doesn't delete the advantages as well as the efficiencies here. These are maybe a little separate.
Okay, got it. And so, you know, as we're thinking through this, like you're saying, flattening the hierarchical structure that we have out there, you know, we don't need an intermediary. Enter Codex to essentially, solve what would previously be done by intermediaries. You guys are enabling through some peer-to-peer connections. And so can you give me a sense of like, who are your current partners and who is doing the most of the volume on Codex, right? I think it's probably not retail, right? It's probably at, some sort of institutional level, whether that's mostly crypto native or it's mostly, legacy finance. Who are the primary players that are currently doing most of the volume on Codex today?
Yeah, it's primarily today, I would think of it as like fintechs and PSPs. Think of them as like bundlers of underlying flows. And we're starting to see companies directly want to do this as well, because who doesn't want, cheaper and faster conversions? And that's maybe the demand side of the business, right? Which is, pretty easy to think about from the customer's perspective. They have fiat, they want stable coins, they want it really cheap, or maybe the other way around, or, between two stable coins, whatever, right? Anything to anything is the new slogan that we're coming up with. So they want anything to anything, and they don't really care what's going on in background. They don't care about CLS, hierarchy, blah, blah, blah. This is all babble, right? Who gives a fuck? Okay, that's the demand side. And then on the supply side, what we're going to be spinning up soon are these on-chain pools that anybody can participate in. And so what can you do? You can stake value in there and you can make money. Now, crucially, this is not a DeFi Ponzi, right? It's not like you stake a DEX token to receive liquidity mining of the token of the DEX that then gets rehypothecated, 12 different ways and some weird thing, very complicated. It's very simple. The money you're making is from the customer who wants to pay a fee to get his conversion done. That's it.
Okay.
And so we're very excited about this because this is in my view, the holy grail in stablecoins, which is build the FX facility that is the globally dominant stablecoin FX facility. And liquidity begets liquidity. And I think this is the crucial primitive that's missing in stablecoins today and what will determine the winner in this next 5-10 years.
And so give us, we may hop back and forth between the traditional legacy, stablecoin or FX stack and back, just to make sure we really wrap our heads around it here, right? Where does most of the volume today happen in the FX market? It's like there's some portion of venues, right? And we're looking to take that, essentially vampire attack it, put it on Codex.
That's right. Maybe I would put it less aggressively, but I think there are massive volumes being done for like dollar euro, right?
Right.
To me, that's not particularly interesting. We'll do that business if we need to, but it's pretty efficient. Okay. Where I think it's most interesting is where one leg is maybe in the developing world, let's say LATAM or Southeast Asia. I think there the inefficiencies are extremely high. And there we can very much offer a much better experience. And so I think these things will start small. FX markets are very large, as you say. Like billion sounds great, but it's a drop in the bucket in the overall FX market. To me, that means that it's a much larger pie for us to grow into. This is truly a massive addressable TAM. I think if we're sober about it, I think we could talk about it as like the addressable TAM today for stablecoins is likely in these kind of corridors where one side has an emerging market need. And this is partly why I think if you see stablecoin teams, spend most of their time in New York and spend most of their time in Europe, you should be a little skeptical, like what's really going on there? What are they actually doing? Like why does Klarna need a stablecoin? Not to pick on anybody in particular, right? But why does a developer fintech necessarily need a stablecoin? These are questions I think folks should be asking.
Okay, and so from your perspective, why does Klarna, like we've been proponents of like pretty much anyone with distribution can launch a stablecoin, and they probably won't be the issuer themselves. Maybe they'll have an issuing partner or some infrastructure partner that enables their stablecoin, but Uber, Airbnb, like all of these guys have the distribution where whether it's for a loyalty program or if it's just to, earn the interest income themselves rather than having money floating out there and, giving it to the bank, getting, pennies on the dollar, they could be taking the interest in their own hands. Is that the primary value proposition for like the Klarna stablecoins of the world? Or is there more to this picture?
I think the primary value proposition of deals like that is hype. And I think the primary value proposition of that is, well, look, like Tether is such a fantastic business, right? It's, it's enormously profitable, very few people. What if we could create another Tether? Mm-hmm. Now, of course, like the problem may be that you cannot create another Tether.
Some people are going to realize that. Yep.
But people are going to try, that's for sure. Right. And so like, it cuts down to two pieces, right? The first piece is, well, if the fintech holds the balances themselves, then a stablecoin is no better than a money market mutual fund or like rolling commercial paper or like, reverse repo themselves, which like, if you're of size, obviously you have some guy doing that. So then the question is, you need other people to hold it, right? Like, why are other people holding it? Do you want to hold Klarna stablecoin, Robbie?
I don't use Klarna very often. If I did and I got some sort of rewards or benefits or special VIP access somewhere, I guess maybe I would consider it. But I would need some pretty good assurances to know that a dollar here is a dollar there. You know what I mean?
That's right. And I think beware the type of thing where it's like, well, that could make sense for somebody else. I don't know. Like, let me ask you this, Robbie. Like, how would you like to do transactions for cheaper and faster?
That's a no-brainer.
Yeah. So I like to bet on that kind of thing, right?
Right.
Let's not do like cartwheels and somersaults in our brains, right? Let's do the stuff that, really moves the needle.
Yeah. And so anything to anything is primarily going to be stablecoin, fiat, stablecoin. Like, do you anticipate getting too involved in, I take it probably not the fiat to fiat world, be it different fiat Forex currencies, but like the fiat to stablecoin world is where I think is probably where there's a lot of creative design space. We have AMMs, right? A lot of the AMMs are pretty liquid. They can do tokens, they can do stablecoin to stablecoin, but fiat to stablecoin is where you need the right mix of technology and banking providers and payment service providers and all these things, right? So give us a sense of like where the fiat to stablecoin on ramp, off ramp flows. What is the stack there? How do those flows look?
It's a mess, right? It's incredibly difficult to wrangle all of this stuff. It's all the stuff that typically a crypto native team A has no interest in doing and B has no ability to do it. And so we're a very strange team, right? We're kind of like part eagle and part lion. Like we're a griffin company. Like one side of it is like very native, extremely crypto native, all the native tactics, and the other side is a lot of trad fintech knowledge. And so, like in my view, there's a lot of pessimism right now, right, about like tokens, blah blah blah. Like, what is the path forward? The path forward is griffin companies that really can understand both sides and can apply these like interesting playbooks that nobody else can even replicate because they don't have both sides of the knowledge in their head.
Yeah.
And so that's what's happening. And I think like you'll see more and more that intersection is where all the interesting things will happen.
I mean, this is what we've been calling neo finance. And so, this idea of sort of, straddling that line in the middle, these teams, there was crypto native infrastructure slop that never found product market fit on one side. That's getting forced to, rethink. I think, man, you coined the term research fetish, which I think was spot on. And we've been using that. Thank you. And then on the other side, you've got this legacy financial, the system that's worked for a long time, but is ripe for innovation, ripe for disruption. They're also being forced to innovate. And ultimately, it's not just that these two things are innovating in parallel, they're actually innovating to the same place. And this is kind of that Griffin convergence area that you mentioned. And this is where, we think that there's a ton of opportunities to explore more sustainable businesses, actual businesses, if you're coming from the crypto world. And we're calling that neo finance because it started with stable coins, but the reality is that there's an entire world built around these stable coins. There's financial mechanisms, money markets, yield sources, all of these things that are built around stable coins. And I think, I'd actually love to explore it from both lenses. Why don't we start with the crypto side? What do you think the crypto side of the world gets wrong about like the more traditional payments side of the equation?
Well, I think first of all, like traditionally the problem has been like nobody wants to even think about it because there's been such a graveyard of crypto payment companies, right? Stretching all the way back to like Satoshi, you could say. Like Satoshi was e-money, but then if the denomination moves is a 10 vol asset, like that's probably not a very good payment rail.
Yeah.
I think of late, it's like just a bunch of guys who don't know what they're doing. It's very hard to acquire the expertise, right? And I think it's very hard to shed old habits. I think many people are thinking of stablecoins as like another narrative to shout about, which is very strange to me. I see some like shifting to AI where like, people want to kind of ride the AI coattails.
They want to do like AI to AI economy using stablecoins.
Yeah. Or like, there's a guy like launching meme coins for, the COD bots and whatnot. Like, dude, like, why are you riding the coattails off somebody else's product market fit? We have our own now. You actually don't have to do that anymore, man.
Yeah. Just
focus on what's working. Look at the numbers, 200 billion to 300 billion. 100 billion doesn't happen. That's not, somebody's not rigging that, right? Like that's real. And if you look at the spread between like, let's say Solana this week is down 17% and Stable is up 40%. Stable is another, stablecoin chain peer type, right? Like why is the spread 60%? Well, because markets are realizing where the real stuff is.
Yeah.
And so really guys, like there's no need to, You don't have to do a little dance anymore. It's here. We're good. Let's just do the thing.
Yep. I think that's why we're seeing a lot more incoming builders, founders into the stablecoin world.
That's right. That's right. Yeah, it's pretty obvious. It's like the timeline is reaching this kind of max pessimism phase, just at the same time, like the product market fit has never been realer.
Right. Exactly.
And so it depends how much emotional volatility you can handle, I guess.
Yeah.
Crypto's always been, if you can't handle the vol, get out.
Yeah, it's always been a roller coaster, man.
Yeah.
Okay, and then I want to get concrete, some commentary on a concrete example in the crypto world. Take Polygon, right? And there's a number of examples, but I think that Polygon is an example of, look, they've been in the space for a long time. They've built a lot of different stuff, from ZK EVMs, all the way through the docket. And now it seems as if they've really recentered around this open money stack, right? This, payments broadly, using stable coins and on-chain rails, acquiring a couple companies. Is this the right approach? Do you think, they've kind of gone too far and they're losing a little bit of, where they came from, a little bit of their roots? Generally, just curious how you're seeing this Polygon open money stack.
Yeah, I don't know too much about the specifics there. I can comment generally on how these chain deals tend to work, right? I think like chain deals, again, these are old habits. Old habits die hard. Like chain deals typically are like, yo, guy, like use my chain, which is the same as every other chain, where it matters, right? Sure, there are like technical differences, but like on a product basis, it's really very similar. Use my chain and I'll give you some tokens. Like that's the classic playbook. And I think that just doesn't work anymore, right? Like I think what you need to do instead is you need to build differentiation that's like real. For instance, if you ask a builder, like, would you like to build on a substrate where you have the cheapest possible FX at all times? Of course, that's a very easy sell. But how would you like to build on this 50th deployment of OP Stack? I don't know why.
Well, we have tokens. Haonan.
Right. Yeah, and like, okay, your tokens are colored green, the guy's tokens are colored yellow, and there's a very thin marking layer around it. It's like, what the hell are we doing here, guys? Like,
oh man,
yeah.
That's when you start seeing the vesting cliff reached meme and the guy jumping off. That's what ends up happening there. Okay, so that's kind of how the crypto side is approaching this convergence. Now, if we look to the other side, I could see how if I'm strongmanning or trying to strongman here, someone from this side is going to say, hey, I think it sounds great. You've got this on-ramp, off-ramp thing. The cheaper, faster, better is a no-brainer. If you can get to that liquidity point where you're able to offer cheaper and better execution. But, Haonan, like, this is a new game for you, right? You guys have been building maybe a couple of years. Like, there's 4x incumbents that have been building for decades. How do you achieve a liquidity landscape, liquidity milestone that ultimately gets you better execution than some of the incumbents?
Because some of the crypto native tactics we know can be applied here and give us an unfair advantage.
Please, more, just what are those? Like, be more specific, unpack that for us.
Yeah, I think there's a really underexploited opportunity here of, the right structuring when it comes to NIM shares of like local non-dollar stables sharing NIM, as well as an intelligent incentive system that, isn't just like trying to drive up TVL for no reason or trying to drive some vanity metric, but is actually creating this new financial primitive of on-chain FX. And like to pull something like that off requires nativity. That's actual useful nativity. There are many smart payments people, right? But this is a totally different ballgame. This is a very different type of ballgame. And so I think, again, like there's this type of intersection that I think is really interesting for the right people to explore, these type of Griffin companies.
Okay. And so specifically, we're looking at targeting like some currencies in developing nations that currently don't have the liquidity topography that a lot of the US dollar to euro, like you said, you're not kind of staying out of that market for now, but you think it is achievable to become some of the most, like one of the most liquid venues for certain currency pairs.
We think so. We think so. And well before we are the most liquid, I think we can be extremely competitive in cost, much cheaper in cost as well. A lot of this is, I think, price discrimination that's being used against people who don't have power. And one of the great virtues of being a tech startup at the frontier is that, I don't wake up every morning and think like, how much gross profit can I generate, right? I don't really care, right? We need to get a network effects, and I want to
Yeah.
grow. That's what matters. Um, and so I think the combination of those forces make it quite likely that for many pairs, many interesting frontier pairs, the on-chain FX markets will become the default markets.
Okay. And so if you're looking at on-chain FX, my understanding is that a lot of the FX volume currently, it comes from speculation. Like it's people that are, taking out some leverage and, they're increasing their notional size by orders of magnitude.
Yeah.
Is that also the case on chain, or is it more for payments and, those sorts of things, or is it also for currency speculation?
We have considered building products that are like specifically tuned for
Mm,
currency speculation, that embed more leverage in them. I think what we are seeing the market pull out of us right now is like real business like players, right? Like somebody really wants to do a cross-border payment and they need stable coins. Or, they're trying to get out of some hyperinflating regime and they prefer to denominate their profits in stable coins. That's what we're seeing right now, and that's what we're building for.
okay.
Like aesthetically, I kind of like that better than,
Yeah.
helping some dude like go 20x long, yen USD or something. That one seems more, the one we're doing seems more useful for society.
Yeah. And so walk us through like the user experience, right? But for a business that is looking to escape a hyperinflationary currency and
Yeah.
utilizing Codex, to get access elsewhere.
Yeah. So there's 3 ways to interact with us today. You give us a ring or, a telegram. You can speak to us directly like that through voice. You can use our UI, which is a GUI, or you can use our APIs. And so depending on the type of business, they'll prefer one of these 3, types of modalities. And across all these platforms, our commitment to you as our customer is that we will source you the cheapest possible FX liquidity. And
Okay.
anything to anything to hammer that one home. Yeah.
And so someone can just give you a call, if they're trying to do a cross-border payment, they can give you guys a call. You'll do like OTC or block pricing and deliver the end currency, the destination currency that they're looking to achieve.
That's
And
right. The denomination you want in the form you want. You want stables, boom, you got stables. You want fiat in this bank account, boom, you got fiat in this bank account. That's what we specialize in.
And so what would you say is the path to scale? You guys are at $1 billion in volume now. How do we get that to 10 billion and eventually 100?
I think the on-chain component of this is crucial. I think it will give us a structural cost advantage that I think is very hard to beat. And I think you can run this flywheel where, the cheaper you're able to provide this FX, the more customers you have, the more liquidity, the cheaper the FX, and so on and so forth. And we have tokens to juice that flywheel. Now, what we need to distinguish here is like a useless Ponzi token incentive thing where like you're juicing a something, but there's nothing there, right? Like
Right.
you're
Right.
you're trying to beat the horse to death, and the horse is dead, and there's not, no matter how much token incentives you do, the horse is still dead. Versus like you are starting an actually useful thing that is going to be like a key primitive in this new system that is novel as well, that nobody has ever pulled off yet.
Yeah. Yeah. We obviously saw plenty of like examples of doing it the wrong way, right? With token emissions, pool two. Now, part of this neo finance thesis is that like there's actual businesses underneath the hood. You need real revenue. You can't just exist in crypto native infrastructure slop land anymore, right?
That's right.
It's a reality check for a lot of these businesses. Last time you were on, we also talked about geographical, like regional stablecoins.
Yeah.
And I'm just curious how you're thinking about this, fast forward a couple months, because if, we go to developing countries today, the most popular stablecoins are a USDT for the most part, right?
Yeah.
Which is the US dollar denominated stablecoin. And so it almost seems like actually, I don't think anyone would debate this, that right now US dollar denominated stable coins have more market fit in the developing nations than like even their own currency stable
Absolutely.
coins, right? So do you expect that to change? Because it seems like in order for obviously fiat to stable coin, even if it is just US dollar stable coin, that can still be a tremendous business. But I'd anticipate that, in order for the on-chain FX market to really take off, we would need some regional stable coins to develop more in growth. Is that how you're thinking about this as well?
We think we have a contrarian view that non-dollar stablecoins have immediate product market fit, and that product market fit will be as a way to do on-chain FX, meaning its primary use will be so that you can trade in that denomination on chain for that FX. Not so much that it itself will be the payment instrument. It itself could be off ramped back into the fiat if need be.
Mhm.
That's kind of our view. And if we're correct, then this is about to get pretty exciting.
And so the way to think about this is more so as like tokenized, like if you look at the US equities market, New York Stock Exchange is talking about getting into, tokenized equities. It doesn't really it gives the shareholder less rights, right? There's like not bankruptcy protection. Oftentimes they're just buying like an SPV wrapper of the actual share. Um, and so, the New York Stock Exchange is still getting into tokenization for these reasons because it can kind of proliferate those assets further. More people can get access. And so you're saying that people may not actually need or want the regional stable coin, specific to your desired and ideal business case before of, hey, we actually want to help people, like we want to deliver these currencies that people actually want, not just a speculative vehicle, right? Are you saying that, regional stable coins are more so a speculative vehicle and those can still provide a lot of value for doing on-chain FX? They're just not to the key business proposition of helping people get the form factor and currency that they are looking for?
Yeah, we're getting into pretty like kind of technical territory. Let me think about how best to express this. So the local stablecoins themselves are an interesting banking rail. Think of it that way, where people who hold that local stablecoin can burn it and get back into fiat. And so that's
Okay.
a very interesting avenue. And so what do I think the non-dollar stablecoin product market fit will be immediately? It'll be twofold. One, it will be people who may want to end up back in fiat, local fiat, right? And there's a way for them to do that. Now, so then why would they go through this like non-dollar stablecoin? It's because then they got the cheaper FX. That's why.
Oh, you're saying it's cheaper to go from their regional stable coin to their regional fiat than go from USDT to their regional fiat.
That's right. That's right. And
I
there
see.
are other like complicated reasons why that might be the case. And then the second interesting use case here is, well, look, if you're sitting in some local fiat, well, what wouldn't you prefer a version of that actually yields a ton more and is safe, right? It's just on the other side of this FX trade. That's what I see kind of the immediate product market fit being. Now, 5 years from now, who knows, right? But I need to live in the present, and that's why again we're so convicted on the direction we're taking.
Awesome. Yeah, it makes sense. And this is something that, like you said, it's a contrarian view. Like I think others are not seeing regional stable coins. They're going their, Circle's got their euro product. Tether is almost going away from this completely. It seems like they're going more tokenized gold than regional stable coins. They just announced another USAT, right? This US dollar or US Tether, like partnership with World Liberty Finance guys and that whole thing.
That's right.
Any comments there? I haven't heard too much about that, but there's other things beneath the
It's a good
surface.
gig for Bo Hines, right?
Okay.
It's a great gig. Shout out to Bo.
Yeah.
Good seat.
Yeah. And then the other thing I wanted to chat with you about here was, the DC rumblings, right? And there was plenty of this at Davos as well. Like, people are worried that paying yield on stable coins is going to end up with capital flight out of US banks and into stable coins. Banks seem afraid. But then on the other side of it, you got Tether saying like, look, we don't even we don't even want to pay yield on our stable coins. We've got plenty of market share not paying yield. Don't come at our bottom line and make us pay yield on the stable coin. So I was on a call the other day, and it almost seemed like it wasn't just the banks and the crypto players fighting it out anymore. It was like this divergence between the crypto players, and now it's a three-headed beast.
That's right. That's right.
Okay. Tell us, where's your perspective on this?
Incumbents are incumbents, no matter whether they're crypto or trad, right? Incumbents will reach for regulatory capture as the tool to keep out outsiders. Yep. So if you're Apollo today, and let's say, Nick Van Eck comes along with Agora, like, what's a great way to kneecap Nick Van Eck? Well, like, make it impossible for him to compete with you on margin. You already have scale, right? Tether doesn't need to pay anybody to use Tether. But if you're going to try to get people to use, let's say Klarna stablecoin, you probably are going to have to pay up in some way for that. And what better way to kneecap the competition than to say that's illegal? It's not possible. Now, like, the deposit-based arguments from the traditional banks, I think, are a little thin. I think the truth is probably the exact opposite, actually. Much of credit creation in the American economy is not actually through the banks these days. It's through separate institutions like credit funds and other places. And part of the reason that rates are as high as they are is because that the banks are this way. And if anything, actually, the movement of capital into stablecoins might actually compress rates and make everything cheaper for everybody. And so I think the lobbyists are making a series of very aggressive arguments that probably don't hold up if you look at them.
Okay. Now, if, say tomorrow, right, you end up getting this Clarity Act approved and they can pay yield, and we do see a capital flight, just, even that may be unlikely. But if it were to happen, even if it's not 9 trillion or whatever, the estimates are from the banks, but, even a more reasonable number, is that a deflationary pressure? Would you say that, because in the traditional credit creation world, right, you have money that's rehypothecated a few times, $1 in deposits is more like $10 circulating, by transferring that into a stablecoin world where everything is one-to-one fully backed, are we taking, the other $9 out of the supply and kind of squashing everything back to the capital base? Is that a truth to this argument, even if it's not 9 trillion at scale?
Let's take any, I think it's it all sounds very scary in the abstract, right? But then once you make it concrete, I think it will be clear why it's not true.
Sure.
Let's say you're buying a house, you're going to have a mortgage, right? How are mortgages created? Now, the banks at some point may have originated and packaged them, but today, sure as hell, they're not holding on to the principal risk, meaning somebody else is holding on to the other side of that stuff. It's not a bank. And so this has nothing to do with you buying mortgages. You and the costliness of being able to purchase a house. And so, credit creation and all these things, the words sound very big and sound very scary, but in actual fact, it doesn't affect you at all. And a second piece of this is that, the banks, not the GSIBs in particular, right, the very large banks, are the beneficiaries of an enormous societal subsidy. We as a society have decided, look, these banks are too big to fail. If something happens, we're going to bail them out, basically, right? They were too big in 2008, and so we made them even bigger. And then now they definitely can't go down, right? Okay. So, that is a subsidy provided by society. That's not something that they necessarily earned or that they have sort of some kind of inherent right to. And they make massive profits off that deposit base. Those profits could be compressed. You could continue to extend loans, but maybe don't make all 4%. Maybe make 3% off the spread or 2% off the spread. Banks have that option. And so, these arguments just really don't hold water, I think, once you examine them.
Yeah. Okay. And so, just putting a ribbon on this, where do you think we go from here with, the stablecoin regulation? If, Coinbase is, fighting it tooth and nail, they want yield to be paid. Tether says they don't want it to be paid. And banks are kind of like, yeah, we don't want it to be paid either. We're happy with the way things are. Do you think we get the Clarity Act, or that might be a tough question, but generally, like how do you think we should navigate this yield on stablecoins business?
Yeah, I think so what is the question with clarity is that an associated entity, not the issuer, is also not allowed to give marketing payments. Now, like the bank lobby's view on this is that, the marketing payment thing is a loophole, right? It's just you're giving out interest, but you're calling it marketing. But if you take that at face value, then like what other financial products are you not allowed to make it consistent, right? Like what other financial products are you not allowed to have marketing spend for? Virtually most financial products have some kind of marketing spend. Let's say the credit card point systems, right? That is marketing spend. And so like for you to be logically consistent across these things, I think you'd have to be pretty radical about your views on these things. Now, like, I don't know if that's how the decision will be made. Perhaps other dynamics are at play there, but I think the facts are very much in stablecoins' favor.
Yeah.
Last point on that.
Sure.
What about the savers? So like people keep making these like borrower arguments. Okay, but what about the savers? Are the savers just supposed to get screwed? Savers are getting screwed with 0% interest rates, right? They're not getting anything, even though risk-free rates are much higher. Are they just supposed to be screwed? Like, this is why the banks flatten the argument as if it's just it's not a set of trade-offs. It's just this kind of bad boogeyman thing. But if you look a bit closer, it's a lot more complicated.
Yeah. It certainly seems that way, and it's too hairy to really get a sense of. We've got actually someone from the Solana Policy Institute coming up next, and she's been on Capitol Hill a little bit, so we'll get a bit more. But before you go, I wanted to get your read on the next Fed chair. Bullish, bearish for crypto in general, bullish, bearish for stable coins.
The Bitcoin people tell me bullish. I don't know. I honestly don't know.
We'll see whether or not, I got to think that he's going to lower rates, right? And then whether that, how that affects stable coins, we'll see. But it seems as if in the past, that's made DeFi rates more attractive. We'll see.
Yeah, we'll see. Interesting times we live in.
Yeah. Haonan, thank you so much for joining, man. Always a pleasure. Would love to have you on again soon because stable coins aren't going anywhere.
That's right.
That's for sure.
Thanks, Robbie.
All right. We'll see you next time.
Soon.
Thanks, man.
Bye.
All right. We'll do a quick break before our next guest, Kristin from the Solana Policy Institute. Get even more politics, regulation going on. We'll be right back after. Yeet is built for big moments. The most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on-chain instantly with Relay.link. Relay is closing in on $10 billion transferred. Go to Relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its real upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more.
Kalshi is the world's largest prediction market. You can trade on anything in all 50 states. Go to kalshi.com to trade today.
Talk to AI like your lawyer or your doctor or your therapist. Yours, private, and here today. Visit near.ai to have a fully private chat experience.
Havachi is fast and private perps trading, secured by ZK with Celestia underneath. Go to havachi.xyz to start trading today.
Looking for yield that stands out? Infinify gives you just that. Deposit stablecoins and earn far more than the current savings rate. Infinify is a battle-tested, reliable DeFi platform that is ready to go. Head to infinify.xyz.
Halliday is unified crypto payments. Give your users more wherever they are. Go to halliday.xyz to never write a smart contract again.
Open, stable, borderless. Frax is building the next generation of stablecoin infrastructure for the digital finance era. Visit frax.com to learn more today.
Yeet is built for big moments, the most fun you'll ever have with your crypto. Go to yeet.com to yeet into your next game.
Not your keys, not your coins. From the team that pioneered cold storage, Trezor has just released its new wallet. Guys, if you are still using hot wallets in 2025, 2026, you are missing the entire point. Secure your coins. Get a Trezor at trezor.io.
Go anywhere on chain instantly with relay.link. Relay is closing in on $10 billion transferred. Go to relay.link to bridge your assets now.
Money shouldn't wait for Mondays. Following its Rio upgrade, Polygon is now one of the fastest chains for stablecoin transfers and payments. Visit Polygon Technology to learn more.
All right, we are back. We are here with Kristin Smith. Kristin, welcome to the show. It's your first time on.
Yeah, thanks for having me.
Absolutely. Why don't you give us a little bit of an intro and a background? You are in DC on Capitol Hill with the best and the brightest working up market structure. So tell us a bit of how you ended up there on DC working on crypto regulation.
Yeah, well, I've been in DC for over 25 years now. It seems like so long, yet it's gone by so quickly. And first 10 years or so, I worked as a staffer on Capitol Hill, working on internet policy issues. This was obviously long before the Bitcoin white paper and cryptocurrencies. I then became a lobbyist for many years. And about 8 years ago, I got into the crypto space by being the very first employee of the Blockchain Association, which I helped to build up over 7 years into the powerhouse that it is today. And I left in the spring to join Solana Policy Institute as president. So it's been really fun to bring my experience to the Solana ecosystem and be a part of a blockchain that is doing so much, building so much, and it's been a lot of fun.
Absolutely. Well, congrats on the move. We've had Summer on the show, and we've had a couple of the people in the DC circuit on the show as well. And like I mentioned, we're excited to go to the DC Blockchain Summit in March and speak with even more. And so give us, before we dig into market structure, give us a sense of just generally how things tend to work on Capitol Hill when legislation is in the mix and regulations are becoming formed, right? You've got trade groups, you've got lobby groups, you've got, the Blockchain Association, now Solana Policy Institute. Just briefly, how do these groups all fit together?
Yeah, no, that's a good question. I think, when I started working on these issues, you could probably count on, two hands the number of people in Washington who were thinking about crypto policy. It was largely Coin Center, the Digital Chamber, and maybe one or two other individuals, but there weren't companies or certainly weren't ecosystems that had specific representation in DC. And so there's been sort of a natural growth of the crypto influence industry, I guess you could say. Trade associations are a very good place to start because, you essentially, a trade association has member companies that all sort of financially support the association. And so it's a sort of a lower cost way for companies to get involved. But over time, the issues get more complex. Companies, have more budgets and you sort of get to the point where you, in addition to having trade associations, which represent an industry, you can also have somebody working on specific issues. And as I'm sure you well know, because it sounds like you've been speaking with a lot of people in DC, there are a lot of issues going on right now. And that means you need lobbyists, you need marketing and communications professionals, you need lawyers, you need a whole group of people to really think through these issues and help get it done correctly. So I would say it's a little bit chaotic, but the crypto industry is very communicative and very good at sharing information, asynchronously. And I think that we probably do it better than any other industry as a whole, just because we come from, a sort of a high-tech, fast-moving industry. That means we can also work on the policy issues in a very collaborative way.
Yeah, it certainly is fast-paced. We like to get things done quickly, and from afar, it seems like maybe DC operates at their own pace, which is
they do not work at the speed of crypto. That's for sure. So, though I have to say, in the past year since the Trump administration came in and the new Congress, the amount of progress that has been made within Congress with the passage of the Genius Act, within the White House with the executive orders, and across the regulatory agencies. It has been a complete 180, because there were some dark days not too long ago, and so much has happened. We still have a long ways to go, but it's been completely turned around from the direction it was headed.
Just one last question on this. Is it that this current administration seems like it's moving so quickly and so fast because we're coming off of the Gensler, Middle Ages, dark era? Or was Gensler just, that era was just so subpar and this is just normal and par for the course?
No, I don't think this is normal and par for the course.
Okay.
Yes, Gensler was incredibly hostile. I've never seen a single regulator so focused on destroying an industry in the United States as we saw with Gary Gensler. And so this is, what would have been normal is to maybe stop the litigation and sort of step out of the way and not get in the way. This is completely different. We have the full support of the White House with David Sachs there, previously Bo Hines, now Patrick Witt. We've had some really great champions from within. And we've had a president who, wants to talk about it and is willing to get on the phone and help get the deal done to get things across the finish line. So no, I would say this is very unusual, and I think we're pretty lucky here in the U.S. because I think if we didn't have this level of engagement from the government, I think it might have been too late for things to come back in the U.S. But because we have that kind of support, I think it's really it's been a huge boon for crypto here in the U.S.
Absolutely. It's repatriated a lot of crypto companies, right? It's not just, it's brought a lot of the foundations, a lot of the businesses that, fled the U.S. during the Gensler era are now back. They're doing business in the U.S. again. And it's a result of, like you're saying, it's both the compounding of, how bad things were, but how good things are now. So it also points to why we should embrace this and really get as far along as possible as we can, because we don't know what administrations, in the future could look like. And so with that being said, why don't we start with, things that are happening just today, right? We're moving quickly. And so today, I believe the White House hosted a roundtable, some sort of working group between banks and crypto companies. And so, given you're in DC, you're on the ground floor of a lot of these conversations, could you give us a sense of, what is happening? What is the purpose of this group session? And what do we expect to come out of this?
Yeah, so the meeting at the White House today, this is not a meeting for CEOs. This was a meeting for people who are working on policy issues, both at banking trades and a couple companies, as well as the crypto trade associations and a couple of select crypto companies who are deeply involved on the yield issue. In the Genius Act, it was prohibited from stablecoin issuers directly passing along yield to the holders, but third-party platforms, like say a Coinbase, for example, has the ability to give rewards to customers for holding stablecoins. So this is a huge incentive for a user to maybe switch and put some value into stablecoins. And so I think everyone in the crypto industry wants this to be preserved, but the banks have decided that they want to try to cut off that avenue and have some friends in the Senate who are willing to fight to do that. So the meeting today was of policy folks. It was at the White House. I was not in the room myself, but I talked with a couple of folks who were just before hopping on to this show. And it sounds like it was a constructive conversation. I think the fact that you have the White House involvement in trying to broker a deal here is incredibly significant. It does sound like this is the first of many conversations and that they will probably continue to have this dialogue. But, when the White House steps in and says, hey, you two industries, you need to figure this out, I think it shows that they want to have a path forward or find a path forward, because they realize unless this gets solved and we can get, both industries around the same page, then it's going to be problematic for the bill moving forward. So, I'm very encouraged by it. I think there's definitely more work to do, but, you don't get White House involvement on issues like this as on an everyday basis. And so the fact that they're doing this shows that they're willing to put in the work to get everybody to a yes.
Yeah. It has primarily been an opposition between the banks and the crypto companies at large. But I think just a few hours ago, and there was rumblings about this last week, the Tether CEO, Paolo, he has gone and said, look, we don't support paying yield to stablecoin holders because, look, Tether's got significant market share and they currently don't pass on any net interest margin. And they've been able to reach scale. And so, allowing stable coins to go on and pass net interest margin to their holders would actually undercut their business, and they might be forced to give away some of their profit margin. And so it feels and seems as if that it's no longer this two-headed opposition. It's kind of become this three-headed beast. Is that the perception? And then obviously Coinbase and Brian Armstrong are somewhere in there as well on the opposite side of, of this, not supporting the bill, but really forcing the issue on paying yield to stablecoin holders. How, give us a sense of the offense and the defense here. Who are the teams playing together? Who are they playing against?
Yeah, well, I would say, and I did not see specifically what Tether said on this. I saw some reporting on both sides that they were supportive, they were not supportive. So I'm not sure what exactly is right. I would say one thing. I think stablecoin adoption overseas looks very different than stablecoin adoption in the US. I think overseas, you have people that are looking to preserve their savings, to be able to hold, their assets in something that is not going to deflate if they have or inflate. If they have an inflationary currency, like they're looking to sort of preserve their wealth. I think in the US, it's very different, right? Like we have a very sophisticated system of payments here in the US, and you really need that extra incentive to get customers to change and to utilize stablecoins. And so I think it is slightly different, but I would say that, I think we want to have as many options as possible, right? Like there's going to be different models and there's going to be different platforms that want to offer different types of incentives. And like we shouldn't deny a platform that wants to offer these rewards to consumers the ability to do so because it's good for consumers, right? And so I think that I think I would say crypto is mostly unified, at least in the folks I've been talking to, and wanting to preserve the Genius Act as is, and not having the banks come in and take away an option for somebody to offer some kind of rewards for the holders of stablecoins.
Yeah. I'll throw my own personal 2 cents in here, which is, right now you go to a savings account at a bank, you're ordering, maybe it's 0.25%. Whereas
it's like a joke. I'm like, oh, good, I got another 32 cents this month. Like, what? Like that doesn't matter to me right now.
No, you find more money just floating around on the street. You just pick it up if it's your lucky day once a year, right? And so, that I completely agree is a total joke. And so, seeing high yield savings accounts at Coinbase and some of these other neobanks, I think is going to open a lot of people's eyes. At least I hope that's what happens.
Yeah, well, and I think too, I've seen some of the arguments that the banks are like, oh, well, if you want to like take deposits, like, just go be a bank. And it's like, well, they're not, Coinbase isn't rehypothecating someone's
Right.
dollar, right? Like the banks are. Like the banking regulation is dealing with that issue where you only have 10 cents for a person's dollar because the rest of it has been lent out. And I think that these are very different things and very different models. And we want Coinbase to be able to do that if that's the way that Coinbase wants to incentivize people to use their platform. We shouldn't deny them that opportunity.
Absolutely. And I just one more thing on this is something Brian Armstrong said at Davos, which I think is important. It flips the banking model on its head. Right now we bring a deposit, whatever the number is, we bring it to a bank and they're surely going to go loan that out and rehypothecate it. The Coinbase model is, you bring your deposits, you only participate in their yield program if you opt into it, right?
Yeah.
Which is, contradictory. It's very different from, the current landscape of you give us money, we're going to lend it out no matter what you say. You don't have an option not to lend it out. And the alternative is, we're only going to lend it out if you choose to, and we're going to pay a higher interest rate. We can kind of see the writing on the wall.
Yeah, no, I think crypto's in the right here. And I think that I'm hopeful that they'll be able to come up with a solution that works for all parties involved.
Yeah. And so with that being said, the Senate Agriculture Committee is advancing, it seems like part of this bill.
Yes.
The stablecoin yield component is holding things back. Just give us a sense of what's moving forward and what is not moving forward with regards to the Clarity Act these days.
Yeah, so the Clarity Act has made its way through the House. The House was able to move pretty quickly last spring. And the House and Senate works very differently, but they were able, with a very strong bipartisan vote, to pass that bill over to the Senate. But the ball is in the Senate's court now. And the Senate is very different than the House. The House is very much sort of a top-down, like you tend to vote with leadership, or maybe leadership is like, all right, vote your conscience on this one and you can do what you want to do. The Senate is very different. And in the Senate, any one senator can stand up at any time and filibuster a bill, which means every single senator is incredibly powerful because they can stand in the way of the progress of legislation. To get a bill through the Senate floor, you need to have 60 votes. Sometimes legislation is added on these must-pass vehicles that you've heard about. That's not really an option right now for crypto, because to, let's say, attach a crypto bill to the National Defense Authorization Act or appropriations bills or something like that, that is outside of the committee of jurisdiction, you have to have the sign off from both the Republicans and the Democrats, and who are the leads of the relevant committees. And Elizabeth Warren is the ranking Democratic senator on Senate banking, and she is not going to approve of any crypto bill being moved. So instead, what we have to do is go through the regular order of getting 60 votes on the Senate floor. 60 is an important number because that's the number of votes that you need in order to stop debate, to stop someone from standing up and filibustering. And so it's a very high threshold. And what further complicates all of this is that this legislation, as you noted, touches the jurisdiction of two different committees. And the Senate Banking Committee has jurisdiction over the SEC and the banking regulators, where the Senate Agriculture Committee has jurisdiction over the Commodity Futures Trading Commission, or the CFTC. And so both committees need to pass their portions of the bill. And the good news is that last week, the Senate Agriculture Committee did vote out their portion. This was on a party line, unfortunately, but a lot of the Democrats who voted against the bill did say they want to keep working on this and that they want to get to yes. So I think that is very encouraging. But the yield issue that you referenced, issues around tokenization of securities, issues around DeFi, most of that sits within the Senate Banking Committee. So I think the work that the White House is doing in trying to convene stakeholders and get to a deal on that piece of it is very important, because it's most likely going to be that we need to have that deal in place before the Senate Banking Committee bill is able to move through its half. But once we get it through the Senate Banking Committee, then the two bills will be sort of pieced together, and they will be ready for consideration by the full Senate. So it's a lot of steps. Some days it feels like maybe we're going backwards, but then there will be a breakthrough and things will move forward. This is like a very normal part of the legislative process, and so I've never seen a more committed group of senators on the Hill and at the White House and wanting to get this done. And so, I think they're taking it issue by issue and step by step. And I think it may seem a little jarring and slow from the outside, but I think that there are a lot of people working on this, and there's a lot of folks that really want to see this get done.
Yeah, and I think there's a sense of urgency to get this done now because there's an anticipation of around the midterms happening later this year. And if those things go a certain way, then it could become even more difficult to get this through the Senate. Is that?
Yeah, I think that's right. I think, yes, typically as you get closer to an election, which we have, the midterm election coming up in November, typically it becomes difficult to get anything done because politics takes over. If there's one exception to that, I would say it could be this crypto bill. I think that, there's been a lot of work that leaders within the industry have put in towards building relationships on both sides of the aisle. And if you look at how bipartisan the votes on the Genius Act were in the House and in the Senate, as well as the Clarity Act in the House, I think this is about as close to a bipartisan issue as you can get. And so I think the window for getting legislation done when it is truly something bipartisan like this is extended a little bit. There are some issues that could be politically problematic. There's been a lot of discussion by Democrats on both the Senate Banking Committee and the Senate Agriculture Committee. There's been a lot of expression of concern around sort of the Trump family's involvement with the industry and having some sort of ethics requirements that are put in place that would be specific to crypto outside of the normal requirements. And so this is an issue that I think, could heat up as we get closer to the midterm election. But I do think we have strong champions on both sides of the aisle, and there is a desire by both parties to get something done. So I'm hopeful that the window will have a little bit more time than a typical issue, just because there is such strong bipartisan interest and support in crypto.
Yeah, there's certainly an interest in getting this done from the crypto industry. And this is at the same time that there's several things that are all built up into this market structure build. Stablecoin yields has gotten majority of the airtime, but you also mentioned tokenized securities. I just want to pass it to you to give a last word on anything that you think maybe the media isn't covering as much as it should be, or the industry, is something that's flying under the radar that you think we should all keep in mind with regards to tokenization, or anything about how the White House or the SEC, CFTC, or just senators in general are thinking about this. Is there any misconceptions or anything flying under the radar that you believe deserves some more attention?
Well, I do think the one thing I do like to point out, and I heard this, I was at the CFTC for a joint event last week that was Chair Atkins from the CFTC and Chair Seelig from the CFTC. And they stood up there together and they said, we want to work together, and we're taking meetings, we're taking ideas, and we're going to act within the authority that we have. And so I think there's this misconception that we have to wait for Congress for the agencies to act. I think waiting for Congress, we need Congress, right? We want these things to be permanent, but I do think there is a lot of clarity that the agencies can work on in the meantime. And so I think the fact that the SEC's Project Crypto is now a joint effort of the SEC and the CFTC is really important, and we should be watching to see what the agencies can do in the meantime while Congress is working on the legislation.
Yeah. Despite the market conditions, we're seeing adoption happen across the board. And so the fact that Project Crypto is enabling, companies to come in, speak to the chairs of these organizations, I think is going to help accelerate that adoption even further. Kristin, thank you so much for joining. This was great. Great insight into what's going on in DC, and really looking forward to the DC Blockchain Summit later in March, and as well as just more and more progress happening on this bill.
Yeah, no, thanks for having me, and happy to keep chatting as these issues move forward.
Absolutely. We'll see you again soon. Thanks, Kristin.
All right, thanks.
All right. Well, that's our show today, guys. So, we had Haonan from Codex come on, talk about stablecoins. Obviously, stablecoin legislation is deeply in the news. And then we had Kristin come on and tell us about how things are going in the DC world as it pertains to the regulation these days. And so it may feel like, one step forward, two steps back. I think the right way to think about this is, things are moving forward on one side of the equation. On the other side, they're still stalled. You heard Kristin talk about how, the CFTC, the Senate Agricultural Committee, has advanced their portion, but a lot of the pieces of the Clarity Act fall within the jurisdiction of the SEC, the Senate Banking Committee. This is the stablecoin yield issue, the tokenized securities issue, and those are still in flux because it requires either Elizabeth Warren to sign off, not going to happen, or more senators to accept that this thing is going to go through. So, guys, we're going to hunker down because we're in it for the tech these days. Careful out there in the markets. It's tough, but stay patient. Because ultimately we believe this is still the place to be. There's still some winners out there. You guys are going to want to pay attention to Hyperliquid. And I would recommend that, the best way to do it is just build, guys. It's the best time to build. Look at the regulatory environment. Look at, the friendliness of the administration. There are opportunities out there. You don't want to make it all back trading. You want to build something people actually use, get some value out of. You can get some value out of it as well. We're going to see you again, same time tomorrow, right here on Rollup TV. Peace.